This is Chad Toyne with a Thursday, December 4 Market Minute from Trader PhD Ag Marketing. In the grains, Treasury Secretary Bessent was interviewed and asked about a range of topics, but when it came to China's obligation to buy 12 million metric tons of soybeans, Bessent said that China was on track to fulfill their obligations by the end of February, and skirted further questioning about the end-of-year timeline, saying that China was still on track, quote, by the end of the season, which he said was February 28. Take this how you want, but it now seems that we are giving China a bit more breathing room to be doing their soybean buying. Beans were lower yesterday, and they have come close to testing a minor support point going back a little short of 4 weeks ago. And now they're trading higher here today. The tariffs and the trade deal and the 9-dash line in the South China Sea and the island reclamation and the tough talk about rare earths is all a huge, complicated ball of wax that the United States and China are battling out. And a soybean deal is likely only a small part of what's going on. China knows that playing the soybean card is a leverage point that they have with Trump, as farmers in the Midwest are a big part of support for Trump, and as farmers, the soybean market hits your bottom line. Expect more bargaining with soybeans to continue with China back and forth for some time to come. The thing about China is that they're not as strong as what they want the world to believe. They have a looming real estate crisis and thus banking and credit crisis that could topple over if the right shifts happened or continued government intervention fails to work. There's no doubt that the United States knows this, and thus time is on our side, but that requires patience. We also don't want a Chinese economy to suddenly collapse, as it would have serious ripple effects around the world, and we don't want to hurt our economy either. As much as we would all want to see this matter quashed, it's likely going to be an ongoing thing for years to come. The question is, just how much of a pawn play will this have on soybeans in the meantime? Anyway, this easing of restrictions on China soybean purchases signals a change in tactics from the Trump administration. The saga continues. On the charts, soybeans have a good chance of testing that 4-week low again, and it may get breached, taking us a step lower to a more major support not that far away at January 1103. That'd be a slide of another 10 cents. On the corn market, corn fell yesterday. We had a crop estimate yesterday from the U.S. Grain Council showing that the U.S. likely will have the largest corn crop on record, 16.75 billion bushels. That's an average yield of 186 bushels per acre. Corn is rebounding higher today after touching early morning lows. Expect both corn and soybeans to largely continue chopping sideways, likely through December. In wheat, the KC-HRW wheat contract is showing some strength, while the Chicago SRW wheat is showing some weakness. The HRW ending stocks to SRW ratio is just 3.2. It's typically 3.5 or higher, and this indicates a tighter supply for HRW over SRW, and that's why you're seeing the spread widen the way it is. In fats and feeders, yet another up day. We've seen higher highs posted every day for most all of the cattle contracts since we had the locked limit down Monday from last week. There's overhead resistance approaching, and the market might need a breather from this rally, especially heading into the weekend. Are we seeing the bulls step back in and accumulating long positions? Who's really left to sell? Anyway, expect choppy conditions while the market tries to carve out a sideways trading range. We will likely leave behind last week's low as a V bottom. After some time, it might not be until January, if cattle starts to trade above the 50% retracement level, it may want to explore some higher ground. But first things first, let's see the dust settle, the volatility come out of the market, and a trading range to be established. Fundamentals will bleed back into the picture with time. And in hogs, prices are firming up and volatility is coming out. All good signs for a market bottom to be in place. Hogs have a lot more work to do to move higher based on what cattle is showing, and cattle will likely lead the way. There's overhead resistance in the February at 83.60, and that's another $2 overhead. And a word about the stock market. In past years, you've heard me talk about a Santa Claus rally in November that can happen through Thanksgiving and into Christmas. We've had a strong stock market coming into the fourth quarter this year, but I haven't seen the quiet resilience this year that I've seen in the past. And that's why you haven't heard me talk about making sure that you're ready for a Santa Claus rally. I don't think the market is in trouble, but it's struggled a bit with general global economic worry. Case in point, look at the gold market. Gold peaked on October 20th and then it fell back hard, and it's been building back since then. And that October high could be challenged before too long. Gold is being used as a safe haven, and there's folks still running for safety right now. The usual calm confidence that you see in the stock market during a Santa Claus rally isn't the norm this year. Just some food for thought. That's it for today. I'm Chad Toyne, and this has been Trader PhD. Past performance is not indicative of future results. Futures trading involves substantial risk and is not suitable for all investors.